Hey, it's CLSK, and this is episode 176 of the Orange Pill Investor. And today I want to talk about MicroStrategy, of course. Um, Discussed a little bit yesterday what you do when you run into the situation where your strikes are breached. And we'll probably not be doing any anything different today, but somebody did mention what about a protective collar? I think that's what they were talking about. And that's generally not something I do. But then the second part of the video, I'm going to talk about what do you do when you have the opposite problem. So I've got some CLSK puts that I close, but I also have one on this small account, and there's no value left in them. So you basically just want to close them early. Um, so let's just take a look at the covered calls that I have, and this is really with almost it seems like this would be cherry picking a case. So the benefit to selling a covered call with a protective put would be against the price going way down. So I'm already limiting my upside here by selling these covered calls at 15.10. So I am not benefiting from this rally right here. I benefited from like 1350 up to 1500, but after that, the profits stop, and the profits are transferred basically over to whoever bought this covered call. And that's actually kind of another good point. It's another reason why philosophically I like covered calls. It's one of the only it's the only one that I can think of off the top of my head where the buyer and the seller can both benefit. So I benefited uh, from 1350 up to 1500. So I benefited from $150 a share, and I got paid this little 1% here. This is just, you know, pennies in front of a steamroller. But I was able to benefit greatly from this trade. I still profited about 15%. My account was able to appreciate about 15% before my upside was capped. So that's a win for me. And the buyer of this call option, he's living large because he bought it for 1300 and now it's worth 15. So he more than 10x. Now I could be mad about that, but I actually, in a weird way, kind of enjoy the covered call because both parties can win. And that's generally not true for a lot of strategies. In general, if one person just buys a call and the other person sells a call, somebody's going to win that trade and the other one's going to lose that trade. If you buy a put, you sell a put, in general, someone's going to win that one or lose that one. But I also still like selling a put because if I sell a put at the price that I like, so let's say I liked CLSK at 1550, I could put in a limit order for 1550, or I could just sell a put here. And if the price goes below 1550, yay me, I got CLSK at the price I wanted, and then I also got this 56 cent, per share discount on top of it because I got paid this premium for selling this cash secured put. So selling a put is also kind of like a win-win, but strictly on the books, you're going to put up $1,550 of collateral here, and you can still call that a win if the price goes to 13 because you got the 1550, price that you wanted, but still your account went down by 200 bucks. So I don't really consider that as much of a win as I do selling a covered call, where let's just stay on the small account for a second. So even these covered calls. My average riot position is 981. So that means I'm going to profit from 981 all the way up to 1050 here. So $70, excuse me, 70 cents a share, which is great for me. And then the other guy, again, he's getting a 10x. He bought this call for cheap and he's getting almost a 10x return. So we're both winners here. There's one winner that's, he's the bigger winner, you could say. But, a lot of the times, even if you're just selling shares, like, oh, okay, well, I'm ready to sell. And then the price goes to 15 the next week and you're kind of pissed off. You're like, oh, I sold too early or whatever. You can't get too mad at yourself if you don't get the absolute top. But the same thing is true. Like if you buy some shares for 10 and then immediately goes down to 5, now you feel like you lost. So in general, in the stock market, it feels like there's a lot of winning at the expense of someone else losing. And so I just really like the idea that covered calls can result in profits for both parties. All right, back to the protective put. So buying the put is even more downside protection. And I will admit that selling this covered call here, if MicroStrategy did the opposite of what it did, and let's say it crashed to 1,000 instead of went up to 1,650, then my account value would have dropped by $30,000 for each of these 100 shares. And this little 1,300 that I collected for each contract would not have even put much of a dent in that at all. So I do understand the theory that buying this put, would have provided some downside protection. But I'm so bullish on MicroStrategy that if the protective put ever makes sense, I just can't make it make sense to me as far as MSTR is concerned. Not now. When, end of 2025, if MicroStrategy is like 10K plus and I'm still selling covered calls, that's something that I would consider at that point. I know some folks like to just time the market. And I guess if you had a magic ball or something, a crystal ball, and you knew that 2000 was the top, I guess you could start buying puts here. And if I was selling my covered calls at 2000, which I was, and then I wanted to just add a put on there, but I don't know how to do this. I don't know how to time the market. I didn't know if 2K was the top or if 2500 was the top or if 3000 was the top. I had no idea. So the only reason that I would even consider buying some of these protective puts and forming a collar would be, like I said, at the end of 2025, and that wouldn't necessarily be because of anything that I saw on the MicroStrategy chart. It would be because I'm still a believer that Bitcoin has a 4-year cycle, and that if Bitcoin is about to go into a bear market, there's a possibility that MicroStrategy could go into a bear market as well. But even that's not guaranteed, because by then, if MicroStrategy's got S&P 500 inclusion, and they could have a bunch of index funds that are just pouring money into it. So even if Bitcoin 4-year cycle does hold, the investors in the stock market can do whatever the fuck they want to do. They don't have to just dump MicroStrategy because Bitcoin is dumping. Now, we have seen it be a correlated asset, but the price of MicroStrategy is just the combined activity between all the buyers and sellers. And so just because Bitcoin enters a bear market, if it does so, doesn't necessarily mean that that MicroStrategy will follow. And even if they do follow, they don't necessarily have to, just because Bitcoin goes up 2 or 3x and MicroStrategy goes up 10x, it doesn't also necessarily follow that if Bitcoin goes down, a 75% pullback, that MicroStrategy is going to 10x to the downside. That doesn't necessarily have to happen as well. So I would consider buying a put, um, late 2025, I suppose. I'll revisit this strategy, but I don't have any intention of just buying puts every time MicroStrategy spikes. I just feel like I'll be kind of, I mean, I guess I could dollar cost average into it, but I feel like every time I would buy a put in MicroStrategy, like if I buy a put here at 1650, MicroStrategy might just go to 2000 or 3000 or 2500, whatever. And that that just seems like just lighting money on fire, I think, for right now. And as far as I'm concerned, I'm already short enough. I know some folks think I'm absolutely insane for selling covered calls to begin with. And so for me to add an additional insurance payment of buying puts, uh, yeah, that doesn't really work for me. So that's part one of the video. And thanks for Minute Skills for asking that question, if I understood it correctly. All right, let's take a look. So I did go ahead and, actually not in this account. There we go. So I had sold 20 CLSK puts last week, the 1550 strike, and now of course CLSK is doing big things, and these puts were almost worthless now. So it doesn't make any sense to hold on to them for 4 more trading days to try to squeeze 3 cents out when I already, I sold them for 52. So I already collected 49 of the 52 cents in one day. I don't need to hold on to this. So now I have a decision to make. Do I want to re-enter a position in CLSK, or do I want to find something else that maybe has not appreciated as much as CLSK? And I was tentatively just kind of tempted to try an iron, selling some iron puts. But if you've seen any of my old videos where I discuss iron, I hate options that don't trade in pennies. And iron, unfortunately, trades in increments of nickels, which mean you could get screwed entering the trade, uh, you know, and exiting the trade. So the premium is amazing here. There's only 4 days left. I guess if you don't count today, 3 days left. And the mid price on this is 50 cents. So putting up 1200 in collateral to get paid 50 cents, that's 4%, and it's not even for a full week. So the premiums here are insane. And I feel like there's a potential for getting lucky here. Sometimes when the nickel um, bid and ask is 10 cents apart, sometimes you can get filled at the mid price and you don't lose anything. However, if you do lose this nickel because of the bid ask spread, that's 10% of your profits. And then if you get screwed on a nickel trying to close it on Friday as well, like if you have to buy it back for 5 cents on Friday, that's another 10%. So 20% of your profits getting siphoned out due to iron having a nickel bid ask spread, that just pisses me off. I mean, it is kind of a discount, I don't I don't really do TA, but like, is this a double top and now iron's going down, or is this is this the beginning of a head and shoulders and then blah blah blah. I don't really get into that too much, but I will say this: iron was $5, and then poof, it's $15. And if Bitcoin wasn't pumping, my guess would be that a lot of times when you get a uh, something that pumps like this retraces, it retraces like 75% of the pump. So this is like $10. So it wouldn't surprise me if this came back down to 750. It did go down to 10. So maybe it could fall a little bit farther before it pumps again or something. Or maybe it's just going to stay here because Bitcoin's pumping and it's kind of preventing much of a pullback that it might ordinarily see. I mean, MicroStrategy did that when it pumped to 2,000. So we go from 500, it doubled to 1,000, then doubled again to 2,000. So it went up about 1,500, and then from 2,000 it crashed to 10. So is iron going to crash some more? Have a similar fate, or is it going to be kind of rescued by this Bitcoin resurgence? Bitcoin's back up to 64. So all this stuff, you know, could be pumping. So let me just go back and take a look at the other option. I can either re-enter a new position in CLSK, and here I can even get 3.5% on 3.5 days, and I don't have to screw around with the nickel trades. Now this bid ask spread is kind of wide, 50. That's like a 20-cent bid ask spread, but I'm pretty sure this will get filled in the middle. Let's just see what the but anyway, I do have one of these on my small account, so let me just go ahead and take care of this before it gets too late. I figure I might as well just do this on camera. So sold this for 56. It's only worth $2. Doesn't make any sense to hold on to it. So I can close this position and get my $1,500 in collateral back. I do not need to obligate $1,500 in collateral for 3 more days to try to collect $2. That is not good use of capital. But let's just look and see if I want to open a new position. And granted, this is somewhat risky, and a lot of other option sellers would just pat themselves on the back and be like, okay, I'm good to go. I don't need to sell a put after it goes up. A lot of them will only sell after it goes down. And that's a perfectly viable um, strategy. But for me, this premium still makes sense. I mean, 3.5% for 3.5 days works for me. So let's go ahead and try to get this filled at the mid price. See if I get lucky or if I have to replace it and go down. All right. So let's try. What did I just try? 71? Try 70. There we go. Okay, so that got him an instant fill. So that'll work. And I have to decide what to do in this joint account as well because I got a bunch of buying power and don't really have any positions. So let's take a look at Riot. If I sell some Riot positions, Riot really hasn't appreciated as much as some of the other ones. So I can get about 2% at the money, 11.5. You also have to look at too, this premium would be much greater if the price of Riot was at like 11.55, because it would be much more in danger of going in the money. So sometimes one stock can look like it's delivering better premium than another based on the collateral, but if the price of the stock is very close to the strike price, you're going to get much bigger premiums. That's not necessarily indicative that the stock is better. It just, at that moment, the price of the stock is very close to that strike. So let's compare that back to CLSK again. All right. But the other thing is this is a margin account. So let me just see what happens if, see, for some reason, Tasty Trade is not really giving me a margin discount. It's charging me full price for the collateral. Whereas with CLSK, I can actually pay less for the CLSK put than I would for the Riot put. Let's take a look at HUT. That's the only other miner that I really trade options on at this moment. So let's just give everybody a fair shot. Now, this one is going to be wildly, I shouldn't say wildly, I'm being extra today. But you can see that the strike price and the underlying price are like almost right on top of each other. So this is getting the absolute most bang for your buck as far as premium to collateral ratio, but there's no discount built in here at all. Now let's see. Yep. And also a very good discount on margin. So HUD is 20 bucks a share. CLSK is 20 bucks a share. And Riot is only $11 a share. I don't think Riot has really, I wonder if it's because they're getting shorted. Those idiots over at Kerrisdale. So it's Riot's gone up about 20% from 10 to 12. CLSK has gone up, what, 16 to 19, so $3 a share. But either way, I'm just not getting, I don't think Riot is a good use of my capital on a margin account. I've got a bunch of, I've got a bunch of HUT down here. Actually, not a bunch, just have 100 shares. All right, let's just see what happens. Let's roll this up. Let's do 20 contracts again. Try to get close to the mid price here. Cha-ching. All right, so you can see my buying power reduced, but got paid 72 cents per share times 100 shares times 20 contracts. So that'll be interesting. See if CLSK drops below 1950 by the end of the week and get assigned. Start the second half of the wheel. Let's see, is there anything else I want to do while I'm in here? What's Tesla doing? Tesla's at 250. Okay, this is going to be, if you're interested in Tesla as well, be on the lookout for another video. This chart like I said, I don't really do TA much, but this chart looks suspiciously like a chart that I saw on a it's formerly Trader University, but Matthew Crater's channel is now Bitcoin University. He basically just moved completely into Bitcoin, which I completely admire and respect. He's he's laser-eyed, Bitcoin maxi focused, so much so that he even just changed the name of his channel from Trader University to Bitcoin University. And there's an old video, I don't know how many years old it is, and the title of the video was When to Buy a Stock, like exactly. And from what I remember, it was something along the lines of, you see this stock and it's crashing, right? Boom. Here's the bottom. And then you'll see, okay, some higher highs, like these were the highs. So you got higher highs, and then it bottomed out here, and you've got a higher low. I think from the video, there was a little bit more of this. It was kind of like you know, kind of gathered a little bit more steam here. And then I think they identified something like this, kind of sideways activity. And then once it cleared, like here was the 200, right? So once it cleared the 200, this was the buy signal. This was like, okay, this stock has now escaped this malaise or whatever. And, you could buy anywhere here, but the question is, okay, was the buy at 220 and the 250 is all the appreciation that you had left? Now, the other thing that makes me a little bit nervous about, I would love to just buy a bunch of long calls here, but as Tesla's been running up, I've actually been selling them off for some profits. Let's see here. I think I had like 8 of these that I bought for 1100, and I sold 6 of them off and basically tripled up on these, which was nice. But if Tesla's now reached escape velocity, and we might see 275, 300, or over the next, however long, if we might see some, especially especially if it starts to escape some of these former tops. And what is Tesla's 52 week look like? All right, so it's not going to be very long before this 300 actually drops off too. So the next, in a week or two, the former 52 week high will be 270. So Tesla will only need to beat 275. So that when somebody goes in and looks at this chart and I'm like, holy shit, Tesla's just beat their 52, just set 52 week highs. And it can just cause a lot of FOMO for people. And so once this like breaches 275 legitimately, not just like, oh, 277, 278 or whatever, there could be a lot of momentum behind this. However, I don't like buying calls when implied volatility is this high. I want to buy calls when implied volatility is low, and then I want to sell it when implied volatility expands. So I'm in a little bit of a weird situation here where I'm watching implied volatility climb as 723 earnings approaches. And then a company usually experiences IV crush. So the 73 IV rank will probably drop in half unless Tesla's price does something crazy. So if Tesla's price collapses or goes to the moon, then, you know, implied volatility could expand temporarily around that. So I'm in a bit of a between a bit of a rock and a hard place because while implied volatility is climbing ahead of earnings, I want to be selling options. But if this is a potential signal that Tesla could be taking off, I don't want to be too short, and I want to be as long as possible. So I may just stand pat where I am with the 2 long calls. Oops. I took a bunch of profits already, and like 2 grand in profits on 6. So really, even if these calls go to 0, I've already basically paid for them with the profits on the other 6. So this is really no big, there's really no harm in me holding on to these. But then the day after earnings, when implied volatility collapses, I may go ahead and re-enter into some of these positions if it looks like Tesla is going to be on a tear. Um, which even if they're not in the short term, I'm a long-term believer in Tesla. So I'm fully confident that by June 18th, 2026, these will be worth substantially more than they are now. So even if I have to deal with some temporary heartburn, I'm not too fussed about it. So I think I'm going to stand pat for now on these long calls. I will certainly take these covered calls off right before earnings. I may not even sell covered calls on Friday since earnings is going to be Tuesday. Might not make sense to sell covered calls and just collect data for one day. See. All right. So I closed these early and then put that capital back to work. So I'm happy about that. Did I do the same thing over here? Can't remember what the hell I did. Yeah, sold the 19.5 put, collected 70 cents here per share. So loving that. This account, I started this as a 5K account in March. So this is doing well. It was kind of interesting because the account went down to like 3,000. So I started it at 5,000 here in March, and then it was worth like 3,000 just a month later. So my 5K account challenge turned into more of like a 5-day or 5K annihilation challenge. But that's the thing is, since then, since April, it's up 194%. So even though I've been quote unquote limiting my upside, picking up pennies in front of a steamroller, this account has still doubled since April. Not too shabby. So I'm not terribly convinced by the limited upside critics. And actually, Robinhood had an interesting, like, little infographic on mobile where it let me look at my profits for options, and I think it was around. So of this, 200% or whatever increase, my options sales accounted for like 20% of that. I think it was 26%. And then the rest of it was just all the appreciation in the stock. And it could very well be that I would have appreciated more if I had just bought a bunch of this crap and done nothing. That is also possible. But I just liked it because it showed, okay, I did get appreciation on the stock, and I did make some money on the options as well. And actually, I think that does prove that I actually made money on the calls because it counts when you sell something for 50 cents and have to buy it back for $1.50, that actually counts as a loss. So the only way that I would have lost more to the upside, to my limited upside, that value would have had to have been red. It would have had to have been a negative number. And so I did make 26% returns over the last few months, just selling the options, as well as getting, a bunch of increases on the share appreciation as well. All right. I think I'll leave it for there. That's how I'm managing uh, puts, selling puts when the price goes up. And that's my kind of general feel on buying puts. In general, I'm not a fan. I think shorting anything is kind of an advanced strategy. Um, Anybody who's just getting into options, I would just sell sell puts and covered calls until I'm making good money with that for 6 months, 12 months. Not financial advice, of course. I'm not a financial advisor, but until I am confident that I have the mechanics down and I'm making good money with it. Then, if you want to start learning about how to buy puts and short the market, I mean, just in general, the market has gone up. It's been number go up for the most part for 100 years. So buying a put and betting against that is kind of a ballsy thing to do just in general. So I would be very confident. If you ever have to say, I wonder if I should buy a put in this, the answer is probably no. Like, you should be just dead set that that's going to be a winner. I think it was a quote from Trade the Trader. Could be wrong, but somebody famous was quoted as saying, like, the way that they trade is they just wait for obvious trades to come and drop money in their laps or something like that. I screwed that quote way the hell up, but that was the bottom line, is like, these trades should just be very high confidence. If you're just waffling like, oh, I don't know if I should or I shouldn't, you probably shouldn't. So with that cautionary tale, this is how I manage selling puts when there's no value left in them. Just close them, reopen them if you want to, or redeploy that capital somewhere else, and try to make the best use of capital that you can. It's probably another good place to put in a disclaimer against using margin. I know I'm using it, and I'm using that as a factor about which stock I actually select, but I have various protections in place to make sure that I do not get a margin call. So be very, very meticulous if you are considering using margin. So with that being said, I will leave it there. Be good, y'all.